Okay, everybody, welcome to the North Star Bad Chart Show again. It's Kevin Wadsworth and Patrick Karim here, and we're really pleased to welcome a special guest today, Francis, the Market Sniper. If you'd like to introduce yourself, Francis, and tell people where they can find you.
Hey, yes, thank you very much for inviting me. Themarketsniper.com is our website. Pop over there for a little bit more detail about what we do. Essentially, we big macro technical, so we like to make big calls. We were recently known for calling the single-digit oil price 2019 going into 220, which was one of very few people that were exceptionally bearish oil then, and we've reverted on that. And Euro Swiss franc collapses in two separate events. So we like the big macro calls, trades, as opposed to activity, long sitting. The money's made in the sitting is one of my favorite sayings. So long holds in powerful moves. So yeah, thank you for having me on. And it's precious metals we're talking about. So I suppose I better get on with it.
Precious metals, we put out a tweet a few days ago, Patrick did, to sort of make a call for lots of views and opinions from people who might have views and opinions who are different to our own. So we're always welcome being challenged with other people's points of view. So yeah, what are your thoughts on what gold and silver are doing at the moment and have been doing just recently, and where they're going?
Yeah, absolutely. Thanks for giving me an opportunity to share a view there. First of all, we see gold as the God market. You'll often hear me refer to it of the precious metals, and also it's part of a category I refer to as the anti-fiat in terms of the relationship with the dollar. And I put it ahead of, Bitcoin and smaller cap other items, but I do have a more broader, looser category on them. And in clarification, in terms of macro, we have been bullish and we are sound money proponents for an extended period. So if I'm just showing the monthly chart there on gold, this is still, and I'll take my sketchy drawings off there. So it's just a clean chart. This is still a macro bull since the Brown's bottom. I think, Kevin, you're probably in the UK if I picked up the accent right. And it's an infamous moment when Gordon Brown, around about 99, I think it was, or 2001 or two, dumped all of Britain, about 400 tons of Britain's gold on the market. I don't think it moved.
The good old brown bottom, yes, we know that well here in the UK.
Yeah. So I hope everyone's had their breakfast and it's well bedded, because we're getting low down and dirty really quick and fast. But in essence, that was a low for which we had a very good run up that took us into the 2011 highs. So overall, my opinion is that we never allowed the fullness of the bull market to play out in full. In short, the damage that was done in the great financial crisis, as they call it, was a depression in my view, but no one calls things depressions until much later in time. Was never allowed to run full course, and gold got put back in its box. So we ended up having the 2011 all the way into the lows of December, Jan 2016, which was when we started to have the China problems on debt that reignited gold. So that has all just been one large correction. Now to call, it's been quite macro to refer to a 2011 event and a 2016 event, just a corrective impulse, because if you were a long gold during that period, it was pretty awful. But that is my big time frame view. We do multiple time frame analysis. So we have 3 primary time frames and we have a super macro. So we're kind of discussing the super macro when we have monthly charts and multiple week charts. So in terms of our history with gold, we were bullish at this point here. This is what we call an HVF, Hunt Volatility Funnel. It's a bespoke squeeze in volatility pattern that we trade. It's close and it overlaps with symmetrical triangles and various other triangles, but it's a subset of that. So it looks for more specific criteria. And we delve into that if people are interested in more detail at the website. So that was the dollar move that we then were involved in and very optimistic about. That was, as I say, going into the Shanghai, China's first major indebtedness issue that saw an accumulation of gold start to come back to regain favor as a strategy. Also, by the way, we do what we call 360-degree analysis. We also compare it against non-dollar currencies, as I'm sure you all have as well. So during that period, just as a bit of a backstory on gold, we'll get to the current now. I know most people are really excited about what it's doing. It's knocking on the door of 1900, and we're going to come up to that. But just to have a full backstory, it really, really helps. So against the pound and the euro, for example, we had similar type macro structures that had us biased very strongly bull. So I'll bring up the euro, but the pound is very similar, and I'll flash the pound as well, because it seems we've got a UK audience as well in the house. And I'm sure they'd love to see that. But this was another HVF structure, which was cleaner on the euro and the pound than it was on the dollar. So the dollar had a big sort of inverted head and shoulder, a little basing structure on the same time frame. This was very, very powerful. This gave us a breakout, and it literally gave us the top of the target as well. So we ceased our leverage longs, recognizing that both we do an investment-based accumulate hodl that I still have. So I had one or two YouTube comments when I said, look, it could be down in this recent squeeze, saying, oh, you're a banker's friend and all of this. Let's be absolutely clear. We want gold to win. We want silver to win. We want sound money to win. And we are at the macro level bulls. But we'll get to what we were saying in a minute once we've covered the backstop story. So that was a key point, and we expected a pullback and what we refer to as progress decay. So the elapse of time without any further positive upside. That can be flat, it can be a congestion, and it can be a strong pullback and then a congestion. It can be any combination of things, and you don't know how long it lasts. And in actual fact, this has been quite a lengthy period that we've been in gestation since that time, and we've had to have Bitcoin move without gold moving, but gold was before the big Bitcoin setup. So we watch this because a lot of people talk about them in a similar segment, the digital gold option. And we also had what we refer to as the first cup gold nugget breakout in Bitcoin. So we had a period of leverage longs in gold, and then it finished, and then we were already long in Bitcoin, and we expected it to transfer. So there was a little bit of an overlap, but Bitcoin lagged gold in terms of that. So where people think who's the first mover, in the macro sense, the God market for anti-fiat still was gold. So that's why I don't fully understand the antagonism between them, but I think they think they're fighting for the same slice of pie. So that's why we get a bit of that. I'll just flash super quick because as I've mentioned, there's also a lot of UK guys in the house. The very close similarity to the euro that the GBP had. So this is gold versus the pound. So this is different fiat in essence, and you can see the structures again there. And we traded in long. It's a nice little falling wedge that gave you the final entry. We talk about 3 impulse falling wedges that are very interesting to us. So we actually got in a bit early on that one. And again, it was a real top trimmer for the pound. So it didn't matter which, you almost got a better target out of the euro and the GBP, but it doesn't matter which fiat you compared it to. Both, all fiat, macro, gold was in a bull market. So that is where we have got up to. Let's get into the more recent timeframes that have started the discussion. So if we're dropping it down into the daily, we've had quite a sustained period. We'll start with the traditional dollar because most people, even if they are in the UK or Euroland, will remember that. We've had a longer than expected gestation period. So gold is actually overdue to run. And the environment is as bad as it's ever been. But we did have a little bit of an inverted structure here that set up these sell-off periods on smaller time frames, and this was your kind of pullback trend, which brings us into where we are essentially today. Now, the points that we made at the time is that people were underpricing the possibility that it could go the other way. That doesn't mean it absolutely means we feel it will, but we're concerned when too much retail was 94%. I think the IG stats, you might have seen it, I shared it on Twitter. Retail is 94% long on silver, particularly. And I was like, I don't like that too much, being too much on the retail side. Technically, we call this a grind line. We're concerned when there is almost what I call bot buying that comes in a very mechanized way under this. We prefer structures where they're not all on the same plane. So an example of that kind of price behavior would be something like that. If I grab all the pivots So, you know, something where you've had it come like that, for example. They're not all on the same plane. We refer to this as grind line, and grind lines often need to be relieved. In this instance, it's not happened. Gold has taken out the last high. So in terms of our concerns on the bear side for gold, it's one of the reasons I wanted to chat as quickly as possible with you, because I had a feeling this would resolve before we met today. Gold has actually shown that it is on the stronger side bullish. The concerns technically as well were that these were very short, what I call church steeple spikes, and then bid absence dumps. So the hang time, so this is technical commentary, which makes this setup higher risk. As it's resolved upside anyway, we now know the outcome for gold, and I'm going to make a point that this can still be pulled back and silver can still fizzle down. There is not a great deal of volume by price that is trading. We call this almost iceberging. So if I throw the waterline at the 1800 mark, which has been a very interesting level, if we count the number of times we've said, and gold crosses the $1,800 mark, it's been many. So you've had bid absence smackdowns and a lot of below the water level price behavior. That is generally, don't be too assumptive. As someone who just looks at squeezes, volatility squeeze type structures, this is something that generally concerns us. That doesn't mean it goes to the downside. It just means the sustainability of the structure can be questionable. Also, this is now calling where there's a short trend that is a corrective trend on the lower time frames. Yes, we're in a macro bull, so we like bull bias, but this has been a corrective trend. To have that kind of structure combined with what has been a corrective trend is also a concern. So that was why we were saying be careful. Then when you added the volume of people that were in on the silver longs, I'm going to go to silver because it's my favorite chart, and this is the one that I actually took a short on, mainly because I actually hold a lot of silver personally, so I'm comfortable with that. It's almost like a covered put, but also because I wanted to hedge against bad risk. And at the moment, I'll talk fundamentally later, and I'll give you a chance to respond because I'm monologuing a lot here. But the covering the technical side, silver didn't pull back as hard as gold for as long. It held a level. That might have something to do with the industrial use case, but it pulled back and that was its low, and it built a bit of a floor of 22. Now, when I looked at the structure that we're sharing here, again, bid absence, hard sell-offs. The momentum to the downsides here has been disconcerting, and it was accelerating. So as you go through the three impulses, there's a 3-impulse swing here, which is a feature we have in our HVF method. The down legs were actually accelerating to the downside. So that bid absence was getting worse, and the stay down time at the 22 level, which is the floor, and we refer to this as locking for where the trapdoor is instead of looking for where the ceiling is, was very, very heavy. So the build-up volume, that volume by price, that point of control is running through the 22.5, where we had a little inverted head and shoulders here on this up leg that ran. So we were micro-analyzing the fact that performed to a target. You had the same over here on a lower time frame, and that didn't. So when you get micro patterns that are performing initially that are bullish and then later in the structure are not, this is also a dissipation of bull tendencies. So as I say, we do drill down quite a lot in this. And so and then when you add it, as I mentioned a number of times now, the overweight retail don't always get it right. That doesn't mean they're wrong when they're there en masse. It's just a worrying tendency. So if we have a look at the structure over here, again, it wouldn't shock me, and this can still happen. So we haven't conceded on silver. This could still happen and have quite a sharp and rude sell-off, just because that tendency has happened. And what another concern is, the silver has not run and confirmed the bull market at the higher beta level that typically should happen. Now that could still materialize, and that could just be another shoe to drop. But if we pivot to the gold-silver ratio, which I'll bring up over here. And I've done this intentionally. I've inverted the chart because we want, in the gold-silver ratio, we want it normally to go down, as most precious metal bulls will be aware of, to confirm the bull market. What I've done by inverting it is just, let's have a look. We want it to go up with the metals. So now everything is going in the same direction. We were involved in the call at 113, saying that was a turning point, and this is now the precious metals bulls reassertion post the COVID 128 that you got on the gold-silver ratio. For us, that's an all-time blow-off high, and again, it reiterates our macro bullish stance. And it was validated, and then you could start to see the loss of momentum that's come in on the gold-silver ratio. This is what we have been indicating with our TA. Then you got that squeeze, and that relieved itself to the downside over there, and that's where the pushback started to happen. And the key level was the 70-ish ratio. If I draw a line on 70 gold, silver ounces to gold, you've got a little bit of an iceberg period above the waterline, and since then we've slumped below. So in terms of how we're doing on the gold-silver ratio, again now, we are actually not going in the right direction. Further, we teach about broadening structures because we focus on volatility. So we're very interested in constriction because that's extreme risk management, super tight and highly explosive reward when volatility returns. And we also look at its corollary, which is broadening structures. So what you're actually seeing is you're getting what we refer to as a megaphone on a bare pole. And this typically resolves to the downside through there. So that actually is pointing to the possibility that the gold-silver ratio will stretch. Now, that doesn't necessarily mean the markets are going down. It could just mean gold's going up and silver's not following to the same degree. But again, that's not your confirmation of a bull market. So that's just there's more I can say technically. We've looked at copper and various other things, but I just wanted to give you an opportunity to respond to that. That's the opening salvo sort of on a technical level in terms of why people shouldn't be too aggressive to assume. And remember, our trade is on the silver. This one has not got away. When are we wrong and we validate it as being inaccurate? On view that people, and let's be clear also on the wording, we are stating that people are underpricing the possibility, underpricing, that doesn't mean it has to happen, underpricing the possibility that a harsh sell-off will come for silver that will bring it back down to the 22 level, later resulting in a trade to the downside. So that is a kind of a deflation, a shock and fear. Obviously right now, doesn't look on because you've got gold doing really well and you've got silver fairly high. This theory of ours, or this possibility or thesis, is invalidated, and like any good technician, there must be a point of invalidation, and that's the stop loss at the 24.76 for us. So if silver trades through that, all that we've said surrounding the concern people should have on the silver market, and in fact actually making it an interesting short technically for this time frame under review, is set aside and is invalidated. So that is our point of being inaccurate. If it does come down hard, what is the juice in the squeeze? Is it worth it? Our opinion is yes, that's why we put the trade on. And we see an 18.7 at minimum. And there's another key element that's a little bit of a bonus, a lottery ticket thrown into that trade, where we would hold a certain percentage of the trade longer for overperformance on account of the possibility that there may well be a structural head and shoulder. Now, you're probably thinking, man, what's got to happen in the world for silver to throw it down to 13.3 again? Well, we had our example in the likes of CV19 in March 2020. I won't say that too often. I don't want to affect your YouTube SEO, but this is a possible left head and right shoulder structure. This was the Wall Street bets high. In fact, intraday it went a little higher, and this is a very clear potential neckline if broken, and that could see a real deflation event. What will the headline be? There will without a doubt be a major deflationary event. Technically in other areas, but of some value or interest, we are at tipping points on debt markets, and I don't think it's going to be managed in an orderly fashion. I think disorderly is almost assured. And that is, this is what we're looking at here is essentially an ETF on the 20-year treasury debt. We called this turn on the COVID. We said that blow off in the surge in that orange box there was a supreme ultimate high valuation for debt, and it's the end of the 40-year bull. And when this structure set up, we said this was going to break to the downside, and it did. And it broke very, very slowly, disappointingly at first for us, who were saying this is a short, this is a short, and then slowly it started to accelerate, finding support at the 135. And we've been calling for right shoulder. And again, you had a complex right shoulder, a second effort that went a little higher, making it a little bigger than the left shoulder, which I'm not a huge fan of. But again, this grind line eventually broken, and then with momentum down. And now it's bounced onto that secret neckline. So a reversal in the bond market where it becomes disorderly could be very supportive for precious metals. Or if it's disorderly and we get panic and fear, you get money running back out of all perceived commodity prices back into the dollar and the debt, and you get a return move. So if you had a disorderly break, you could get some form of a return move. They're going to have to watch the manner in which the debt deflates if this macro reversal story is true, and if it reverts to fear, that could also be part of the narrative stroke story that could see metals at the paper level, because you and I all know we are physical holders, that could see that at the paper level that drop, and premiums I would expect would absolutely extend. So I don't think you would get to purchase at $13.50 for all the tea in China, and supply would no doubt be pinched. So yeah, that's a bit of a quick technical hit. Any comebacks on there?
It's brilliant stuff, Francis. I love it, all of it. It's yeah, there's some cool stuff, man. I like to see you use volume profiling, which I'm a super big fan of, to see actually the density. Sometimes like I always say, like a pure chart trader, by the pattern size, he's able to figure it out. But for somebody who a newbie, or somebody who just wants to see, like, for that structure where the weight is and where the point of like no return, like if you see, so that's, and I told, like, silver, I totally agree. Like I'm keeping a close eye on the gold silver ratio, the DXY and the VIX. And if by the end of the month, on the monthly chart, the GSR, I think it could break to the upside. That's super scary. So I really want to see it subdued. And if it's subdued, that means we're going into your orderly transition from equities, like let's say to commodities. But if it spikes up and everything goes mayhem, dollar is going to go up. Your silver trade is going to look great for the short term. The only thing shorting silver on the smaller timeframes, when I know and it's in a long-term uptrend, you have to be a very nimble trader and keep your eye close on the ball, because that higher, those deflation events, they spike down, but they should get bought up pretty fast. So
you've got to have your take profits in. So our whole thesis, very good point. I mean, you raised a bunch of good points in there. The whole thesis is the entire trade strategy is placed. The stop, the take profit, and everything in everything we do. In other words, the only way you can be a lifestyle trader and sit in your balcony and have a look at the cargo ships is to know that your closes are all in on the trade. So you're very right. It would be a dip spike, and then it would come back as fast, and you'll lose 50% of your profit just by going and having a cup of coffee and a pee. So the whole strategy has got to be put in. The other thing I really like that you came back at me on, and that I didn't introduce, because it would, if I did the full thesis, it maybe be a bit long-winded, but the dollar index. And the dollar has actually been relatively benign during this period after being pretty strong generally. So this whole break period has come during this period, and our concern, where you may have heard, I think that fiats fail on dollar strength. It's a little bit counterintuitive. There's a guy that's made a theory around that, Brent Johnson, and I actually think he's onto something with that. And technically, for me, that I see evidence. In other words, this is also very bearish, the euro, but there's other currencies like the Swiss franc and the pound and the yen in the Dixie, but it's 56% euro, I think, last time I checked. Anyway, we see euro great pressure on the euro, and we see that a flight to dollar. So in the event of the flight to dollar coming back in, because we have this macro thesis, and I'll just show you how macro, just super quick on this one. I'm going to choose the other dollar index, which I've done on the monthly. This is our monthly take on the dollar index. actually on the dollar index, let's get that handsome faces to one side there. Again, 3 impulse falling wedge. This is part of our theory. This number 3 that came in at 2008, this is a monthly chart of the dollar index, was the 3rd impulse for us of breaking out of a macro falling wedge. So most of the compression was on proliferation of the dollar coming across these highs. You know, the highs were coming hard down here, but the lows were just making relatively lower lows, not quite the same amount. So the squeeze has been in the lower level being slightly down and a lot of constriction across the top. Then we had this key moment that coincided with 14-15, and it also was the first oil smackdown that we were also involved in calling, and that came on a dollar surge. So I don't know if you recall, and it was also a Ukraine-Russia escalation. Irony of all ironies, it feels like the same playbook. 2014, we shorted at $103. I remember them saying on CNBC, are the first guys to call oil short at $93. I was like, man, you guys are late. And that was all on the supposed war that was supposed to happen, the Maidan Square events of Ukraine, which take you back. But that was all around here. And you had the dollar really, really hoofing it up and breaking out of this falling wedge. And since then, our hypothesis has been this is continuation pattern on the macro level. And again, we've got our 1 impulse, our 2nd impulse that was done. This was really hard down. This went with the 7 trillion proliferation Trump-Biden era as they were handing over. And since then, dollar's been snapping back really, really hard. And we expect, look, it could have a down leg still, and that could be very supportive, a little bit of a deeper down leg. But on the longer run, we're seeing 110 on the dollar. Now, to many people, that's like, wow, that's going to be terrible for the euro. It's going to be hard on the Korean won, the yen, and many, many others. And I've seen also, if you look at assets to GDP, the euro and the Japanese are much worse off than America, and Britain is kind of in between. So when you look at those ratios, currencies will be affected. So when we talk global macro, because this is what we're trying to do, we're stress testing a gold trade, but we're recognizing all the levers that are playing in that, which includes the dollar-based currency. We're saying, hang on, we are going long gold in an environment where generally over the longer term, we are expecting a firmer a dollar, and that can come in surges and lags. Obviously, if we have this down leg right now, gold can get away up to 2,000, 2,100, 2,200, but when the dollar starts going, and I also make the key point, we are truly in reset when gold is going up on a going up dollar, and that point has to happen too. And that's a great moment for all of us, precious metals, physical holders. And that will be an event, but that flippening where they are not contra proportionally inverse proportionally correlated is still to happen, and we can't talk about that yet until that event comes, and I think it's a very disorderly event. I also have a third kind of speculative, this is totally spitballing and speculative, that I'll throw out to you, your guys, and the general audience. I have a concern that the control structures, the Klaus Schwab's, the W economic forums, and I won't take you too far down any rabbit holes, but that there are potential deflationary events that will be required to stop the disorderly decline of the debt market, to create that fair trade. So we've heard them speculate about a global hack having a further bigger reach than even gold and silver markets. So there is a massive amount of orchestrated event risk that generally will potentially firm the dollar up, put the brakes under a sliding debt market that could then work adversely for a period against gold and silver. I've felt that as the traditional trade of 3,000, 5,000, God knows how many years buying precious metals and getting physical, the paper proliferators, which is our central banking cartel, are not going to want us to win. Inherently, we are the enemy as rational thinkers that are attempting to defend our asset classes. So you could continue to have manipulation on the paper level, and then you transition in a reset environment, a third, like a Bretton Woods Mark II moment, and it could either become illegal or greatly taxed if you're a physical holder. Lots of potential things, and we'll never see gold and silver potentially in this side of reset trading in the paper markets to the value it deserves to trade to. All that value will be attained in a reset environment, post a reset environment, where they will reval gold maybe at 50,000, whatever the currency denomination is, could be, global dollars, or whatever the case may be, or in the equivalent of legacy dollars, and silver at 500, for example. And that's the moment you only make it post reset, but then there'll be tax extraction. You'll have to have it registered. We're seeing more precious metals being sold with chips in it to protect you and to verify that the gold is legit. And I'm guessing pretty well locatable by a man in a truck with the right equipment as well. So to all our guys that are in the precious metal and also looking more beyond those reset things, there's a couple of big things to think about. So unchipped gold, put off out of banks, held by yourself at home in a hole, do some midnight gardening, whatever you do. Maybe the reward comes out, and you might have to bootleg, keep quiet about owning it, and have a few invoices of sale to Joe Schmo in Antarctica ready to present to the Gestapo of the day. So just some thoughts for the guys out there. I don't know if you want to come back on that.
Yeah, that's some really mind-blowing thoughts there, and it's a lot of the sort of stuff that probably a number of us have thought about before, and where this might all be going. And the idea there of the US dollar index, and how it is really just a comparison of the relative strength of the US dollar and other fiat currencies, principally the euro, of course, but the yen and the British pound represented strongly in there as well. But it's not that difficult to envisage a scenario where the fiat currencies are jostling for positions, swirling around the drains, whilst gold is quietly appreciating against all of them. It doesn't necessarily speak particularly about the inverted commas, the value of gold, the fact that the US dollar index happens to be rising. And there are plenty of instances throughout history where the dollar index has gone up and gold has gone up at the same time, and quite recently as well. I think 2000, can't remember if it was 17 or 18, that kind of period. There was quite a sustained period whilst both went up together. So people do tend to forget that, and people do seem to also forget that gold has outperformed the S&P over the last 20 years. When you actually go back to around about the time when I started investing in around about the year 2000, gold has well outperformed the general equities. It just depends on your particular investment time frame that you're looking at. But yeah, and the whole thing about silver as well, I find quite fascinating, because like you, I've got plenty of charts that do show an interesting and it almost like possibly a historical sort of separation between gold and silver going on at the moment, in that, for example, gold is only I don't know, maybe 10% or less, 5% off its all-time highs, whereas silver would need to go up by 100% to get to its previous highs. So it's an interesting period that we find ourselves in, whilst gold has been pretty robust, and silver took that smash down, and it's kind of it's just basically gone sideways, hasn't it, for a long period of time now. And I'm not really going to be joining the really bullish camp on silver until we get clear of $28. That kind of area around 28 seems fairly significant to me as well. So I think you mentioned 25 and a half, and that general area in the mid to upper 20s is going to be where silver proves itself, or as you say, takes a dive down. I think for some particularly low value, I think I've got $15-16 on one of my charts. But yeah, certainly is I agree. If silver doesn't prove itself, and if gold were to not hold this breakout above 1850 or thereabouts, then I think Patrick's got some charts showing the significance of 1875 as well. The monthly close is still well over a week away yet, so the monthly charts and the monthly close will probably tell us a lot more about what's occurring here.
Yes. On a bullish, yeah. Sorry, carry on.
No, well, no, I have just one final question there, but I'll let you follow up on Kevin first, if you don't.
No, I was going to just add on that we did one particular video on the gold silver analysis for an extended multi-decade, really far back. And it really proves, in my opinion, unfortunately, I don't have the charts because it was very well annotated. I can maybe send some links over retrospectively. I don't want to spend time scratching around for it. But overall, it proves that the 2011 was a truncated bull event that never was allowed to complete because we didn't do the gold silver ratio full swing from value to from one extremity. And actually we see the possibility in this extremity of the reset event when silver unleashed to actually fall below for a small period, because what we've actually seen is the volatility has been increasing in the gold silver ratio, mostly leaking out the top. That's why we've seen the 128. But what we did observe is every time it went significantly higher, funnily enough, it did pull back immensely, apart from the 2011 peak bull. We could see it, don't lose entire faith in silver. We could see it go sub double digits to the gold silver. I could see 9.99 again. I think that can and possibly could happen. But the world that we'll be looking at in that event is a very different world. But you do need to have the big time frame charts. You do need to be looking at each of those big bull cycles. And I'm very keen for silver, but I think it has to be the great unloved for an extended period before we get to that event where it can hyper overperform. And this tends to happen at much shorter periods of that extremity, and it gets suppressed for a lot longer. But when it does, it can move very, very broadly. So don't lose faith in silver. I still think it's a great metal, but I just think paper performance-wise, it's probably also the easier one to control as a smaller market. I think gold, I have a theory. This is a spitballing, again, live spitballing theory, and I've spoken about it before on the precious metals, and seeing as we're doing a deep dive here. What I've noticed is that the debt markets, and I think the relationship between the debt markets and sound money and gold, everybody has established, but they haven't taken it to the level of, okay, how's this working? So whilst America and China at a nation state level are supposed to be antagonistic, of course, there's a lot of trade, a lot of apples are being made there. So there's these multi-layers to relationships. So whilst there might be this supposed militaristic adversarial, there's this huge trade of, of interdependence upon each other. When you look at the trillion plus that China holds, Russia has been divesting and buying gold. China has not gone below the 1 trillion mark and still holds 1.1 trillion around, give or take. It's being adjusted marginally, slightly up, slightly down. And you would ask, on sound money principle basis, given that it's an open secret in the political circles about the lack of sound money and the fact that we're end of cycle, why is China not dumping in its nation's interest that 1 trillion? And the only reason I would say is because there's a coordination between the interdependence of the parties. So what could you do that could have someone continue to hold something that they would see as grossly overvalued? Well, you create a discount window somewhere else where they can acquire something where they net gain even more as a result of holding this stinky pie in the one hand, they get an amazing 3-course meal in the other. What could that be? And the justification for making such a speculative conspiratorial theory is if you look at the Asian pricing and you take the last decades just of I think it's the London close, so the Asian session, and you're net long during those sessions, and then you can revert short over the American session, and then be a buyer again at the open of the Asian session. You actually get two different charts. I described this recently, but if we have an access here just to do a sketch on our value, you actually get on the one side, you get this incredibly bullish chart of just trading the Asian longs.
I saw that chart, Francis. It's like, I don't know, it's super high, the price of gold. If you did that strategy there that you just mentioned, it's like, it's night and day compared to the NYMEX gold chart.
Yeah, if you follow gold and metals quite a lot, it's quite clear that there's a clear advantage. So where the gold price might be the gray line, It's actually the hybrid of a real parabolic blue line and a fairly bearish orange line, which is the American session. So it looks like a discount window is being held open. It's been created in one session for accumulation in another. And you've also got to bear in mind that COMEX doesn't do a great deal of physical delivery, and Shanghai does an immense amount. So where is the real market? You end up coming to the conclusion. So you have, markets are manipulated without a shadow of a doubt, and people are being convicted, and more people are understanding that it's not, it's not tin pot hat territory. So that's just another thing that everyone I speak to, I think, maybe that's how you get people to hold that. You create a window for them that they are accumulating. And China hasn't reported on their gold holdings in ages. They mine themselves, as you're probably aware, and they are importing. So the numbers that are coming in through Hong Kong and other ports is huge. So these guys are going to probably announce a massive gold hoard at some time. It wouldn't shock me that they go straight to the top of the pile by some multiple even. They could even be 2x, 2.5x American holdings.
And of course, when they do that, the dollar value of gold will probably go through the roof once that becomes common knowledge. So the timing of that will be quite important. I would imagine they'll pick their moment to announce that.
Just on the euro, which is the inverted Dixie chart, some people find it easier to see head and shoulders like this. This is why we remain bearish, and we've actually made a euro Swiss franc call as well.
I'm just laughing at your labeling there, armpit 1 and armpit 2. I like that.
Yes. So we shrink wrap the head. We're like serial killers. You open our fridge and all the heads are got a little bit of a shrink wrap around it. So we like to determine at what point the left shoulder's ended and the head is started and when it's completed. So yeah, that's our naming standards. But this has certainly taken a little bit of an interesting route, but we still expect 110 fours to be run to the downside on the euro. And when you bear in mind, markets never travel in straight lines. From the top of that right shoulder, it's been, a return move to the neckline. It's been a very, very strong selling period. Many people would have argued the Eurozone would have been most uncomfortable about how disorderly fast that's been. So the fact that we've gone a little bit walkabout now, a lot of pump and dump and churn, I think it's just the next crisis waiting for that down leg. When that happens, I don't know. But I would say on balance of probabilities, I'm expecting this pattern to perform too, which again is endorsing the Dixie analysis. So we look at the same Rubik's Cube from every angle in this great game of trading and market analysis to try see, have we really got this right? Just like you guys, and I want to applaud you both for, celebrating someone who was maybe at a moment in time, possibly quite incorrectly, had an alternative view and trying to get to the bottom of that view, because that's the real endeavor of true traders. So you're certainly showing that spirit in terms of how you do what you do. So well done.
Well, yeah, we sort of encourage a weight of evidence approach and try to let the charts speak for themselves and remaining as unbiased as is possible. I mean, you might not know, I'm a scientist by trade, a meteorologist and an atmospheric scientist. So, I'm kind of trained to just kind of think that way and try and clear my mind the whole time and remain open-minded. So, that whole approach about just building the evidence. And as you said, any good chart trader will have those lines in the sand where your most favored theory, and at any one point in time, you always have a most sort of likely outcome, if you want to put it that way. You're just analyzing what may happen in the future, and you kind of arrange your future scenarios in order of what you assess is the most likely, always being aware of the fact that something that only has a 5% chance of happening sometimes does happen, and you have to spot when that 5% likelihood event is actually turning into what is actually going to happen. So yeah, I mean, that's why we have the approach that we do, and why we welcome all views and opinions. So and in fact, as it happens, a lot of what you've said, does chime with our thoughts as well.
Yeah, the mental state just prior to a massive loss is always conviction. And I think in the spirit of that, I felt that there was a lot of groupthink of conviction that the only way was up on that. And we like to generally be practice contrarianism. Sometimes at the risk of being inaccurate, I'd say on gold, we've already been inaccurate. That $1880 as a taken out that technical, so that is not going to be. But our main trade was on the silver market and its lack of buoyancy, but that may also fail in time. But I'm okay with generally trying to wear the jacket of the 6% rather than the 94% as a rule, but it has to be justified. We don't just be otherwise just for the trying to be different either. And I felt there were some concerns, and I still feel those concerns exist on silver. So you could have this messy situation where gold technically just runs a number of key levels and actually does go higher. And maybe I should just bring the gold chart back up, and is quite zippy. The other point I was going to make is that commodities generally are going to go into a macro bull. Generally, that's my view on the big point. But oil was knocking very close to the $100 mark. And we felt, combined with that, with Bidenomics and midterm elections, especially with inflation, is very stubborn. They should have killed it when it's small. You kill a monster when it's small. We are not putting this inflation away easily. I remember the Volcker years. I've got the hairstyle of a man that actually was around for Volcker, and you just didn't put inflation away. It just was nagging, and he cranked rates up. In actual fact, if you look at shadow stats, we should be on Volcker rates right now. Those debt markets are hopelessly overvalued, which should mean that gold should be much, much higher in actual fact on all levels, on the macro level. But we've got to deal with this fakery and almost, I'm tempted to say fuckery, that these guys are throwing our way, and adjust accordingly. But I remember those levels, and inflation isn't going away, and he wanted and needed that to come back from running the 100 mark, because it was picking up $1 a day, and it was at, Brent was at 96 and WTI just $1.50 behind. And that actually that's another one to look at, because it is such an inflation feeder. We did the Dixie dive, but for the guys that are in the metals markets, if they enjoy just learning and looking at the variables, whether we turn out accurate or inaccurate in our hypothesis, this was getting very much close to that key triple-digit mark. And now you've had a little bit of choppiness coming in here just before the 98. I think this is going to have some degree of pullback of before it runs 100, but we are hundreds, and we are 250s in time. That's obviously not next week, but I'm talking as part of this inflation play out, we're going to get squeezed. This is the Rockefeller tax to end all taxes. It's a tax on movement. It's a tax on purchases. It's a tax on anything that's delivered. It's a tax on plastics and packaging. This is, this is the inflation aspect. And when we called oil short, we had actually had this, and we went many people don't know about our gold. Gold was along when we went for oil to single digits. It was a two-leg trade. Everyone said, oh, you called oil down to single. We were doing gold oil analysis, and oil had become disproportionately expensive to a weak gold. And that is almost that ratio when you do the one divided by the other. So relative valuations, very important as well. We were at all-time lows on the gold oil. So not only were we saying short the oil, the long was the gold, and gold was at about $1,300 on that, that falling wedge. And you actually could have got it for 998 pounds at its absolute low. It was just around 1,000 pounds level. So that people forget that you would have also had the upside of that on that particular call. We're almost in the other way round a bit now. Oil's done immensely well on its reflation. So gold will have a bit of catch up potentially, but it was just a case of there's so much downside risk out there right now on this debt unwinding. People are underpricing a shock event coming out of the blue, whether it's global bank hacks and a variety of other things. And I get concerned when I see utter conviction and one-sided trades, particularly at the retail.
One thing I just wanted to ask you, actually, I mean, oil here has clearly risen, I don't know, 50% or whatever it's been, but some of the moves in things like gas and electricity prices, globally, but I'm talking particularly here in Europe, where we've seen, the market sort of prices for wholesale gas and electricity. I mean, they've gone up by hundreds and hundreds of percent, and they're sitting at levels that are 2 or 3 times higher than their historic seasonal highs. I mean, I'm thinking particularly about how this feeds into the things like the producer price index, because we're seeing rapidly rising inflationary pressures here in Europe and the UK, where, for example, hauliers, trucks, companies that deliver the goods are having to paying increasingly higher energy costs, not just energy to transport from A to B, but energy costs in terms of heating their premises, where you've got workers in warehouses and all that kind of stuff. I mean, my domestic fuel bills here have gone up by over 100% in the last 3 months. Those kind of rises, for UK householders, 100% rise in 3 months. So what I'm getting at is, this move up for oil, gas, and electricity. I was looking at this, last year, and jumping up and down and shouting about it when it broke out, and stuff was starting to look a bit unusual. And I was saying back then, well, it's one thing if this is a spike, and this just spikes up and then comes crashing down as fast as it went up. But if we're going to move up and then establish a new plateau, a new level that is, higher than the previous all-time highs for the baseload gas and electricity prices, then we've got a problem, because that kind of market, the excuse me, the energy markets, that's going to bake in an element of inflationary pressure that just is not going to go away, and I'm not sure people are prepared for that.
And I'll tell you something that the Eurozone does to infuriate it further is that unlike the US that kind of stayed out of the Paris Accord, they've gone the full carbon credit route, and carbon credits as a market are absolutely rocketing. And this is a cost for commercial companies to do business. They have to offset and purchase these things. Yeah. So the Eurozone outlook for inflation is absolutely horrid, because you're going to get that in the corporates. These also, I put up the natural gas chart because you mentioned it, but actually the price is being paid in Europe now. It's not even the settlement figures of the natural gas chart. It's a far worse one. If I could get the chart for what it is, I've seen that. So that's Britain and it's Europe. And they are far more reliant on gas in terms of heating, because American is more electricity orientated. So that is going to be an absolute killer. You think of all your cold little old ladies and David Cameron's advice the last time this happened of just wear a woolly jumper and all of that nonsense. There's going to be a lot more of that. And there's going to be, and it's going to feed through very powerfully inflationary, and you're going to get a doubler effect in the corporates having higher cost of delivery on these supposed evil energies, and having to spend a lot more on ever spiking carbon credits. So the carbon credit markets, after a bit of a bumpy start and a major fizzle out a while back, they are now, their time has come. And people should consider even getting long a little bit of that if you've got the patience to macro. And that's going to cause a much worse catch-up inflation. And the problem there is that they don't have the scope or the ability to raise rates any more than America, in fact, less so. And this is why I see the Eurozone, the euro itself collapsing immensely. I don't think Britain is significantly better, but it is better. And I think Brexit, in terms of this currency collapse, will turn out on that level, at least to slightly ring fence them from the downside in that for your.
Well, that is the biggest advantage, I think, of Brexit, is not being tied to that particularly large ship as it inevitably sinks at some point in the future.
100%, and with that, I'm absolutely confident. No, it's been great, guys. I've got nothing more for you, and I'll need to sign off in the next few minutes. But I don't know if you've got any last questions.
I think myself and Patrick just want to say a big thank you for taking the time and trouble to join us. What you've run us through there has been absolutely fascinating, and I'm sure our listeners and watchers will be absolutely over the moon to listen to this and listen to it many times over. I think because there's so much information in there.
Exactly, and hopefully you'll come back. Me, I say never judge a chart trader by his calls. If he respects his trading framework, and for me that's a successful trade. So somebody's has a different view, but he's respecting his own framework. It's everything's good there. So yeah, I'm sure we could talk another hour, but let's schedule it for some other time and have you back on, Francis. There was a delight.
Absolutely. I'll just confirm on the silver side, we are still short, although we're an embattled short. and the invalidation level for the detail of the trade, everyone will know and can come and go, yeah, boo, at 24.78, that takeout, I would certainly close. But it could still, if there's suddenly, I'm relying on a very bearish event to occur to bring us back into the game. So the invalidation is 24.78, and then we're looking at least for 18, we do a partial close, and then 13.5 on a major drama event that we'd call an overperformance trade. If the guys enjoyed what they heard, we would love to have their support on the YouTube channel. That's at The Market Sniper. And if they want to know more about us, the website is www.themarketsniper.com in terms of how we approach the markets. Thank you for having me on, and let's do it again.
Thank you very much,
Thank you,
Francis.
Francis.
Good talking to you.
It was an honor.